to JPX Energy Market Weekly Updates. The oil market wrapped up another volatile week, swinging up and down in a wide range as we pulled between bullish and bearish catalysts in both directions in different time horizon every day. The broadened consequences of the war in Ukraine and hawkish U.S. Fed monetary policy to bring down inflation have continued to result in rising oil and financial market volatility. In the short term, there are growing concerns over the refined product markets. What started out as a target middle distillate market appears to be spreading into the gasoline market, with EI reporting another significant draw in gasoline inventories and high implied domestic demand. Despite pessimistic economic expectations, with an expected return of Chinese demand, summer driving picks up, and jet fuel continues to recover globally, global refinery output is struggling to keep pace to seize product supply tensions. Crude oil demand remains robust. Oil prices reflect those tensions as North Sea dated Brent prices have moved from discounts to IC Brent futures to premiums since the beginning of May. In-a-month spread of major crude oil benchmarks also strengthened last week, with the spread of JPX Dubai crude oil contract through July and September settling equally around $4.8 per barrel. In the physical market, Asian demand for July low to Middle East and medium soil grade, such as Oman Blend, Absakum, is reported to stay strong as these grades has more gas oil yields, and refinery margins for middle distillates remain healthy. The spread of JPX Dubai and IC Brent could be well supported at the current level. In addition, the spread of IE Shanghai crude oil and JPX price difference is also likely to widen because of tightening of the most deliverable oil grades and the lower standard warrants. The Asian gas oil market has been on strong footing since the beginning of the year due to limited supply. The supply tightness has been further exacerbated by the war in Ukraine, which has led importers based in Europe to seek gas oil from other sources to reduce their reliance on Russian barrels, resulting in a strong pull for Asian gas oil barrels from the West. Reflecting the increased flows of Asian gas oil to the West, the volume of usual low sulfur diesel arriving from the east of Suez to Europe rose 12% a month to about 1.66 million tons, according to reports by Platts. And the data analysis shows the production profit of diesel and jet fuel are highly correlated with the overall margins of a refinery. While Russian flows to Asia reported continued, this is then little to damn sentiment for Middle East and medium soil crudes. Market participants fear Middle East and medium soil crude could be pressured by regional refiners, including those in India and China, considering the option for cheaper Russian grades such as medium soil Urals. Chinese demand has been a concern due to lockdowns hurting oil consumption, but signs of improvement were now visible. ChemChina, as well as independent refiners, were heard to have bought a total around 14 million barrels of various Middle East crudes earlier in the July trading cycle. And according to market sources, China is likely to see a second batch of oil product export quotas released in June, besides a temporary supplementary quota released last Friday, which could lead to further appetite for crude oil buying interest. And lastly, limited average barrels from the West have also boosted the interest for Middle East grades. The Brent-Dubai spread, or the exchange futures for swaps, the EFS, is often tracked as an indicator for North Sea low sulfur crude value versus Middle East high sulfur crude. And wider EFS make crude priced against Dubai more economically attractive compared to Brent-linked ones. Since the outbreak of the Ukraine war, the benchmark Brent crude has maintained at primary level to other markets. And US WTI has been gaining prominence lately due to Europe's move to impose a formal embargo on oil from Russia, which is pushing countries in the bloc to raise crude supplies for other markets, including the United States. The U.S. refiner is also trying to ramp up activity to meet domestic demand, which is also squeezing WTI higher. Last Tuesday, WTI cross-brand to trade at 115.4 versus 115.2. Take pipeline cost transportation costs into consideration. Arbitrage windows shut to ease in Europe. Iraqi-grade Basra median is heard to have emerged as a choice for Mediterranean and Northwest European refiners switching from Russian grades. In the medium term, as high energy prices impact every part of the economy, the fight against inflation becomes more complicated for the monetary policymakers, including the U.S. Fed, as steeper interest rate hikes could lead to deterioration of economic activity, household spending, and ultimately recession. A flattening U.S. bond yield curve also signals a possible recession. However, this worry has yet to be reflected within actual demand data. Okay, that's all I would like to share with you this week. For more information on the energy market, please stay tuned for JPX Energy Market Weekly Updates.